Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio. Our next guest is one of our returning regulars. Once a year or so, maybe twice a year, we bring him on to give us an update on all things in the high-end retail side of the spectrum. He is Randy Frederick, the Director of Trading and Derivatives over at Charles Schwab. Randy, welcome back to the show.
Thanks, Mark. It's great to be with you.
You know, we love having you on for a number of reasons, not just because your face is plastered all over the internet. You are indeed quite the online darling these days. I can't go to any financial site without seeing your face.
I suppose that's a bit of an exaggeration, but I'll accept that.
You know, but one of the reasons we really like to have you on is because you do a lot of in-person stuff. But, you know, I'm probably even getting ahead of myself. Let's go back. I'm sure we have a lot of new listeners since the last time you were on. And let's explain to them exactly what the Director of Trading and Derivatives does at Charles Schwab.
Okay, so I kind of have sort of three roles, the way I describe it. I'm an analyst. I analyze the options markets, and I relay what I see in terms of the way I interpret all sorts of different things, various different types of put-call ratios, volatility, option volume, open interest changes, all sorts of things. I communicate that on a weekly basis in a blog that I put out in our Schwab community, exclusively for our Schwab customers. I also do PR, so the reason I'm talking to you, I talk to many members of the media on a pretty regular basis, sometimes is I would say on average maybe one reporter a day. Sometimes I don't on a day, but then I'll do 3 and 4 in a day. And then the third thing I do is education, which is probably the part of my job that I'm most passionate about, and it's probably the one that takes up the greatest portion of my day. I do education in a lot of ways. I write articles on a pretty regular basis, a couple of months, that are posted to our website, record seminars for self-paced tutorials for online webinars, do live webinars, and then I spend a lot of time on the road. I'm on the road probably about once a week, traveling to some city around the country to speak at some sort of client event, seminar. We do very large educational events about once a quarter in some city around the country. Next week it'll be in Seattle, and these events are attended by sometimes 400 to 600 of our active investors, and we'll do maybe 3 sessions during that day, different topics about options. Also do partner events with the CBOE, and we do those probably about once a month. We go to some city there, and these events are usually attended by somewhere between maybe 80 and 130 clients. They're not all clients, but the vast majority of them are going to be Schwab clients, and that's a piece that I think is really important. It's a key driver to the growth in this industry, and it's something I've been passionate about for a long time. I'm happy to see that there are a lot of people involved in that element of the business right now, so it's really good to see that the demand from the clients for options education is growing all the time. So that's something that's a good thing to see.
And that's one of the reasons why we like to have you on the show, because you do a lot of the face-to-face stuff. You get to interact a lot with the retail audience. I mean, obviously, with a lot of online users, but you get to speak to a relatively active and motivated. The people who actually come out in person to these events are usually pretty motivated options traders. So I'm curious, as someone who deals with these people on a regular basis, what kind of questions are they throwing at you these days? What are their concerns that they're seeing? What kind of strategies are they asking you about? What's the kind of feedback you're getting from them on what they're looking for in the options market right now?
So great question. Probably the overwhelming, overriding theme on most of these large client events is that active investors want to be continuously engaged and involved and in the market all the time. And even when the market gets in some of the worst turmoil that it's been in, such as in late 08 and early 09, these investors do not want to get out of the market and be in cash. They want to be in the market. But of course, the one thing they don't want is to see their portfolio lose 30 or 40%. So the biggest demand these days, and this is, again, a very positive shift from my perspective, is they want to know, how can I remain in the market during times of turmoil and not get clobbered and not lose 30 or 40%. So believe it or not, despite all of the innovation in the industry, all of the complexities of the different types of strategies, the thing people want to know more than anything else is, how can I stay in the market and generate income in a sideways market and hedge myself a little bit when the market gets rocky so that I don't have to sell my position. So simple strategies like just simple covered call writing and selling short puts to get into positions and putting on a protected put and really a strategy that would have been just phenomenal in late 08, just a simple collar strategy. It's a very low cost, easy way to protect. When things get crazy, you sort of lose your desire to have additional profits, and what you're really more concerned about is just holding on and just maintaining your ground. And I'll tell you, just about any active investor would have been thrilled to have minimized his or her losses in 2008 to maybe 10% 10% or less, because very few of them probably did that well. Most of them probably lost a whole lot more than that.
Talking about collars, I imagine that interesting study the OIC did recently on the collars and how they performed over the past 10 years has probably been a good tool. The typical viewpoint of the collar is that it will underperform in any sort of extended bull market period. But that showed that, on a risk-adjusted basis, it certainly outperformed the underlying. And even on a pure return basis, it was extremely competitive, if not outperforming some of these pure underlying trades. And I think that surprised a lot of people who traditionally have a dim view of collars. I'm sure that's probably been very useful when you're talking to people about collars these days.
Yeah, I have seen the report, and I will say that I was a believer in the strategy way before I saw the report. And I don't know how many of our customers have probably seen it, and I don't know that I would use the report directly to sort of prove to our clients that that's the case. But you're right. I mean, in all markets, maybe putting on collars and maintaining them on all your positions, certainly that's not a wise strategy. You're going to cap off your upside substantially in order to get the downside protection that you need. But it's the same sort of argument you could make with just a simple buy right or covered call strategy. Okay, sure, in an extremely bullish market, the buy right's going to underperform. And in an awful bear market, you're still going to have some losses. But by and large, the majority of the markets are moderately bullish, moderately bearish, or sideways. That's the bulk of the market time. And in all three of those scenarios, the buy right's going to outperform. So overall, you're going to be better off. The collar, sure, I always recommend that people have some sort of hedge in there, at least on some positions, the ones that they have the highest or the most concerns about. But to say that you ought to have a collar on all your positions all the time, of course, that doesn't make sense. But the thing is, if you go back to, say, early 08, when things just started to, when all sorts of ugly things started to rear their head, the whole Bear Stearns debacle and all these sort of things, no one really knew how severe, how long, or how deep the recession that we were about to enter was going to be. But everyone knew something was going on. Everyone knew that the housing market was starting to show real signs of trouble. The volatility was starting to creep up substantially, that things were not good. And the bull market that we had been in for 5 years was starting to get pretty gray, right? And again, I don't know that any of us knew that the severity would be what it was. But the fact is, when things are starting to look a little uncertain, everyone sort of has these feelings, and you can see it. That's the time when you say, you know what, it's been a good run. No, I didn't need all that insurance over the last 3 or 4 or 5 years, but hey, my portfolio's up 60, 70, 80, 100%.
Yeah, let's lock some of this stuff
Let's
in.
lock some of this stuff down. And that doesn't mean I got to get rid of all of it, but hey, if I could just get myself into a neutral phase, which is what I could do if I put a collar on. One of the beauties of the collar, if there's anything about a collar that's just beautiful, it's the fact that no matter how far out you go, it doesn't get more expensive. Most option strategies always get more expensive as you put on more time, but collars don't, because the put and call continue to cancel each other's time value out, and eventually, so however far out you need to go. And it might have been a bit unrealistic to think that if this is March of 08, that I would put on a collar for 12 months. Okay, granted, I don't know that the recession is going to be that long or that severe, but hey, I could put one on for 3 or 4 months, and then at that point in time, would things have looked a little worse? Yeah, they would have, and I would have immediately rolled out of those collars into new ones that I might have gone on for another 3 or 4 months, and each time I had a chance to look at what the market looked like, and eventually I would just keep rolling into new collars and just maintaining my positions going forward until all of this really scary stuff started to go away. A lot of people knew something was going on and that it was going to get shaky, but they didn't do anything, and they took enormous drawdowns. The collar could have prevented that. So it's good to see people asking for that kind of help now.
Yeah, this is definitely a time when it's good to be an options evangelist, because people are having their come to Jesus moments. They realize, well, maybe I should have had some downside protection. Especially right now, we're seeing a huge influx on our side of everyone wanting to add some sort of downside component.
Good example. Again, I mean, most bull markets, the vast majority of all bull markets last a lot longer than this one. This one's about 13 months old, but it's been a phenomenal run for 13 months, right? Now, does that mean I think we're going into a bear market? Certainly not. But is there a potential for a pullback or some slowdowns here? Absolutely, there's a possibility of that. Does that mean I should collar up every one of my positions? Maybe not. Or maybe you put them on for some of the ones you're most concerned about, maybe the sectors that have had really good runs, because there's always a rotation of sectors. There are areas that do really well, and then they cycle out and new areas come in. If you've got a segment of your overall portfolio, and at Schwab, we're big advocates of having a well-diversified portfolio that goes across many asset classes. If you've got a segment that's done really well, think about taking some of that off the table, at least in the form of putting on some protection, because that's going to cycle out. Something new is going to take over. And we do analysis, and we put out ratings on the market sectors specifically for that reason, so that people will take advantage of that.
Now, we're talking about collars. It seems like you're a champion of the zero-cost approach. You put them on in the same month so that premiums cancel each other out.
In general, I do think that's a good
because it's a little easier to visualize.
You don't want it to get too complex. I mean, it's not a complicated strategy. Certainly, if you start mixing strike prices and mixing expiration months, it can get very complicated. I think by and large, for the vast majority of all people, keeping it as simple as you can is the best approach, because when things start to get too complicated, and we've heard a lot of discussion at this conference about complexities of all sorts of things, complexities in pricing, complexities in products, complexities across different exchanges, all sorts of things. And it's interesting because the keynote speaker the other day, one of his key points was
complexity. I heard about that. Yeah.
Cut down on the complexities. It's not that we don't have enough information; it's that we have too much information, and we need to make it simple. So, I'm a big fan of trying to keep it simple. And I think if you're looking for a long-term strategy in an entire portfolio where your goal is to continuously manage and create and close and all that, this particular strategy over a long period of time on all your positions and achieve some sort of key performance result, then that approach in the report, sure, that makes good sense. But by and large, most active investors want to be engaged in the market. They want to be buying stocks that they like and then closing them out when they hit profits and getting in and out, and they want to do a variety of things. The collar really only comes up in a big way when the whole marketplace starts to look a little shaky. And then it kind of makes sense to go in, and then they're within the collar for a specific reason to sort of lock things up for a while until the anxiety goes away. Not as a sort of a long-term, constant rolling strategy to achieve results. I think that particular approach, is probably better in a strategy where you start out using short puts to acquire positions and then selling covered calls on them when you get them. If you get called away, then you do it all over again. I think that's probably a more successful long-term strategy over a long period of time. The collar then only comes in when the market starts to look a little crazy and you really decide, hey, it might not be an environment now where this strategy I've been using is going to work, but I need to maybe just hold my ground for a little while until the craziness goes away. That's kind of the approach that I take, and I think that is probably more realistic for the vast majority of all investors that I talk to anyway.
I'm glad to hear that you're hearing inquiries from active traders about using short puts to leg into long stock positions. I try to preach that gospel a lot, and people always come to us, my God, it's so risky, and yet they're writing covered calls all day long, and they don't see the flip side of that coin. That's usually an eye-opening moment when we explain that to them, that they're doing the exact same thing. So I'm glad to hear that people are coming to you and embracing that strategy, because in many of your average retail, that should be the way they're getting into their stock position. It makes a lot more sense for them.
Yeah, of all the strategies that I teach, and again, I can teach strategies from the very simple to the very complex. The majority of the strategies I teach are fairly simple, and I think, again, it's because it works best for most people. But of all the strategies that I've taught, the one strategy that just puts grins on people's face and the light bulbs go off more than any other is the simple short put strategy, as you just talked about. These are people, by and large, people start out investing. They're going to trade stocks for a long period of time before they even consider the idea that, hey, maybe I should think about adding options to my overall strategy to enhance, to provide some hedges, to generate some income, things like that. But a lot of times, as simple as the short put strategy is, it's amazing how few people really never sort of think about it or come up with it on their own. And when you show them how simple it is, how the profit and loss chart looks just like a covered call, how the cash outlay is significantly less, even though the risk may be the same, the cash outlay is a whole lot smaller. And I love to ask a big room at an event, how many of you, when you've done all the research you do through whatever means you use, and you come to the decision that you found a stock that you like and you want to get into it, you enter a limit order to buy it below the market price. And 90% of the people in the room will put their hands up. Every one of those people could do the exact same thing by selling a put at a strike price close to that limit price. And now there are small differences, because if your limit order is hit at any time throughout the month, you're going to get your fill. Whereas with the short put, it has to be there at expiration, and you're not likely going to get early signed on that. But that's the big difference. But for the most part, it's amazing when people sort of see that. You mean I could do this? I could end up buying this at roughly the same price in all likelihood, and if I don't, then I get paid anyway. It's just, I love to see the reaction, the smiles on people's faces, and the light bulbs light up when I show them the short put strategy and how similar it is to limit orders, how the P&L is similar to buy rights, and they just go, wow, this is incredible. And I've had so many people come up to me after events going, I've got to try that. That's incredible. And I that's what makes my job worthwhile, and I feel very fulfilled when I'm done with an event when I hear those kind of comments.
You and I talk a lot about the active trader element over at Schwab. And we always talk about sometimes they get in a little bit over their heads. I think the last time we talked about them wanting to dive into VIX and how maybe they weren't ready for that yet. So I'm kind of curious, are you still seeing that interest level even when the VIX at these low levels? And are they still wanting to dive into, let's say, VIX options and futures? And are you still trying to steer them clear of that?
Yeah, there's still a demand for the VIX, clearly. And I think that, as you know, the volumes on that product continue to grow and grow and grow. And it's not all institutional, even though it may have been when it first came out. But I think the good side is this is, again, where education is the key. The VIX product is not necessarily inappropriate for a lot of retail investors, but it's just important that they understand what they're trading and that they realize that you're not going to see movement on these options relative to the spot VIX price. And I don't necessarily try to steer people away from the product, but I'm always very firm in my point that if you're going to trade this product, or if you even think it's appropriate, please go out and do the research. And I don't necessarily do seminars where I go into the details of exactly how it all works, although the partner events that I do with the CBOE, of course, they talk about it. It's a big product for them. We're doing one, in fact, just a few days ago here right in Phoenix. Jim Bittman from the CBOE, okay. I'm sure you know. And we've done many events together. And he did spend a portion of his presentation on the VIX products as well as the other index products. But it's just key. There's nothing wrong with the product. But it's different. And there are several nuances that people need to be aware of. It's unfortunate that people have to lose money sometimes to realize that they're trading a product that they don't fully understand. So once they get educated and if they're understanding the product and they're familiar with it and they want to continue trading, great. Then there's nothing wrong with that. But I just think it's really, really important. And again, that goes back to, again, what was discussed in the keynote speech yesterday. Again, how many times were there major meltdowns? The Enron debacle was one that he talked about, where there was an enormous amount of information out there that was available freely to anyone, not hidden documents, not secret stuff, that anyone could have read, financial statements, whatever it was, to have a full grasp and understanding of what's going on. But they were, frankly, to put it, for lack of a better term, lazy. And I think it's amazing sometimes to me that active investors will be lazy and they'll go into products that they think they understand and they haven't done the real research and they haven't spent the time to educate themselves. It's important to kind of tell people that, hey, when you're an investor, it's like a business. It takes a lot of time to get it going. It takes a lot of capital. You have to manage your capital and manage your risk. You have to educate yourself, and you're going to have losses and gains. All those things apply to just about any kind of business, and investing is the same way. Don't make the mistake of putting your real money on the line on a product that you really don't completely understand.
Like I said, one of the reasons we like having you on is because you have your fingers on the pulse of that Schwab active trader community. And I know one of the things you guys are talking about here down at OIC this year is you actually just have the results of your new active trader survey. And we talked to the OIC recently about their retail survey. So I'm very curious to hear some of the highlights of what you guys found talking to your active trader community.
Okay, so we do this. We do these, as I mentioned previously, pretty large educational events. They're full day long, and we do them usually about 4 a year in different major cities around the country. This one came from shortly after an event that we did in Orlando earlier this year, a couple months ago. And we ask some of the same questions each time, but there's also a few interesting additional questions that we'll ask at each survey. This one was responded to by, I think, more than 500 of the attendees. And some of the key items that came out of this survey was that these active investors, for the most part, and we define active investors at Schwab, possibly a little different than others, but typically people that do about 36 trades a year or more. Okay. And that's the low end threshold, but we certainly have people that do hundreds and maybe even thousands of trades a year. But we start the group out at sort of the 36 trades on up, and the people who attend these events are typically in that demographic. But what we found was that compared to, and that's really where the most interesting part comes from, is to compare it to where people were a quarter ago. And another, I think, important note here is that retail investors as a whole are often perceived as being largely on the wrong side of the market. When they're bullish, it's time to get bearish and that kind of thing. That's not true for the most part with these active investors, because these are investors that are engaged in the market, that are watching the events as they unfold, that are aware of what's going on in Washington and in New York and in Chicago and wherever, and are in touch and in tune with what's going on in the market. They have a lot of years of experience for the most part. So they tend to be more on the right side of the market. So a lot of times what these guys are seeing and what they're saying and the trends that we see are pretty indicative of where things are going. So a good example would be that in the previous survey, we found that a pretty sizable number of these guys were bullish, and that in fact was 50% that said they were bullish over the next 12 months. Well, now about a quarter later, that number has dropped all the way down to 28%. That's a pretty substantial.
That's
drop.
substantial. It's
that
interesting
doesn't mean
too.
they went bearish. It just means that they're not as bullish. They've gone more into the neutral camp.
It's interesting to see that because you talk to all the professionals at conferences like this, and they've been overwhelmingly bearish for a long time. The assumption was always that, it must be retail who's bullish, who's driving this stuff up. Your numbers are seeming to contradict that. There.
Yeah, and again, it doesn't mean that we're become bearish or anything like that. Just that, again, because they know through experience and through their level of engagement in the marketplace, the fact that they do go out and spend an entire day acquiring education that's going to help them be successful, that, again, as we at Schwab always advocate, you should look at your portfolio either twice a year or at minimum once a year and reallocate. You're going to have sectors that have done well, that have performed well. Take some of that money off the table. We've had, as we mentioned previously, a 13-month bull market. And aside from a small 9% pullback in late January, early February, it's been pretty much straight up since then. So it just means that, hey, after this long of a run where we've had gains of, I don't know what the number is, but it's up in the 69, 70, 72% range probably since the bottom back in March of 2009. It's pretty substantial that maybe it's wise to take a little bit of this profit off the table and go into a little bit more of a neutral mode here potentially. There's a fair amount of research out there right now that says that there's a pretty high possibility of a slowdown here in Q2 and Q3. Q4 may well be strong, and overall net for the year, I think the expectations in general are that it's going to be an up year. But with the kind of run we've had, historically, you'll find that bull markets tend to be the strongest in their first year. They tend to be a little less strong the second year and a little less strong the third year. Well, we're clearly into the second year of it right now, so that doesn't mean we won't have a positive year, but to have a year that turns out as strong as 2009 was seems pretty unlikely. And I think, again, these engaged investors are aware of that. They don't necessarily want to get out of the market and go into cash, although they have allocated a little larger portion of their portfolio into cash. But again, it's time to take a little bit of it off the table to put on a little bit of protection.
In addition to the sentiment changes, what other sorts of takeaways are you finding from your surveys of the active traders of Schwab?
Well, one of the things that we always ask about is their use of options, and there's been a pretty consistent for the past couple of years anyway in terms of their use of options. It's in this last survey, 40% of the attendees of these events are not just option traders; these are active investors. 40% of them are option traders as well. And one of the things I think is really important, and it's very encouraging again for me in the role that I play, is that by and large, the overwhelming majority of these people who do trade options, 74% of them, in fact, use options for the right reasons. They're using them for income generation. They're using them for hedging, which is something that I think is a significant transition over what you might have seen 3 or maybe 5, 6, 7, 8 years ago. And it's a good thing. It's an evolution that in the marketplace that's good for us because options are a derivative, and derivatives are an enormous category, as we know. They often got grouped into some of the stuff that caused the financial meltdown.
Oh, yes.
That was, of course, we all know that wasn't caused at all by exchange-traded, highly regulated, fungible option products. But a lot of people don't necessarily understand that. And they then are often perceived as simply vehicles for speculation. The fact that the active investors realize that that's not really the only use and certainly not the best use of them, and they're using them for the right reason, that's very encouraging for us. And that's what we stress. All of us that are in the education part of the business in any manner stress that, I think, pretty regularly, and it's great to see that people are finally seeing that and they're understanding that. So that's good for us.
Now, Randy, I know you and I can gab about a variety of options topics all day, and we have in the past, but I know you have to run pretty soon. So before you go, I know you mentioned a little bit before about the Schwab community. If you can give us an update of what you guys have available up there. I know it's been a big push for you guys going forward, and a lot of brokerage firms in general. That seems to be one of the new differentiators. And it used to be education and tools, and now it's education, tools, and community is the third pillar of that strategy. So give us an update on what you guys have available on the Schwab community and what you're planning to add in the near future.
Sure, great question. Social networking, as you know, is enormous. It's growing like crazy, not just for this industry, but really in every industry and every business. And it's something that we put together a couple of years ago. We now have probably around 11,000 or more active participants in the community. It's exclusively for our own customers. You can go right into the community right from the Schwab.com website. There are a number of us that are regular participants in terms of providing content. I write a summary blog every Friday afternoon about the options markets and publish it in the community. where I analyze the variety of factors of what's going on in the industry, from all sorts of puts and call ratios, all sorts of volatility indications, you name it, and sort of write up a summary of what happened this past week in the options market, and then what to look forward to for the next week. We option traders in general tend to have a little shorter shorter term outlook than just strictly an equities investor. So we have plenty of people at Schwab that provide analysis for a long-term investment plan. I'm usually trying to put out something that people can use to decide or to see what might potentially be coming in the next week. And there are, again, a lot of participants. There are a lot of different topics. You can talk to people that do what you do. I think there are some pretty vocal and highly experienced, successful investors in there that are more than happy to communicate with everyone else that's in there. So yeah, it's an amazingly successful launch, and a lot of participants, more being added every day, and the amount of content. We have people that put in fundamental content, people that put in technical content, active trading type stuff. Again, my area being primarily the options markets.
Well, Randy, that's about all I have for you today, unless there's something that you would like to add.
I think we've covered a pretty good chunk of this. If we go back and look at the survey, some of the other topics, I guess, that are kind of interesting is that one of the things that I think is very fascinating is the fact that there's so much going on in Washington, as you know, with policy decisions, all sorts of things going on, that these active investors, one of the questions we added this last time was how big of a concern is that for you? Is that something that's top of mind? And in fact, aside from just overall market performance in general, this came up as the second most important thing that our active investors are keeping an eye on. They're concerned about it. Now, how it's going to all shake out and whether it'll be positive or negative, no one knows, because how these things end up looking when they finally come out versus how they're initiated is anyone's guess. But it's interesting that active investors are so closely engaged in what's going on because they're concerned about how that might affect them. A couple of years ago, it wouldn't have even been on the chart at all. So that's a pretty interesting thing to see.
That really is fascinating. That continues to speak to what we've been saying on this show and what a lot of our guests have been saying for a couple of years now, is how much the high-end active retail segment of the option space really has grown and evolved over the past 4 or 5 years. 4 or 5 years ago, if you'd asked me what was retail, institutional, there's a 5 up, 10 up guy, that was retail, and then 1,000 up was institutional. There was not much in between there. Now you have this vast space of high-end retail, which includes, former market makers who are using retail accounts now for a variety of reasons. Basic retail customers who've kind of come up through the ranks and educated themselves and through 3 tools and education of the brokerage sites, and now they're trading much larger size, regardless of where they come from. But they all dovetail very well now with what was traditionally considered to be institutional stuff. Regulatory reform, market structure. We're getting a lot of requests, and it looks like your traders are saying the same thing. They're paying attention to these things that were never considered the bailiwick, so to speak, of the average retail options investor. That audience has completely transformed in recent years, and they're paying attention to things that were never on their radar in the past. And it's fascinating to watch that evolution take place.
Yeah, and it's a good evolution, again, because it all speaks to the level of sophistication, the understanding now, and I think this was driven largely by this last pullback in the market in 08 and early 09, the understanding and the realization finally now that people have to be responsible for their own portfolios and their own investments and their own retirement. And that means that they have now understood and they now realize that they have to invest the time and make the effort to learn and to educate and be aware of what's going on. The days of just handing everything off to somebody else and blindly letting them manage it for you have changed. I'm not saying that there aren't plenty of people who still do that, and Schwab offers all sorts of the whole gamut, from people who just will occasionally help you out to people who will completely manage everything. But even those investors who have handed off things are engaged and know what's going on and ask a lot of questions and are a lot more familiar with exactly what those money managers are doing in their accounts than what has traditionally happened in the past. But that can only be good.
Yes.
You can't overeducate. You can't become too knowledgeable. You can't learn too much information about what's going on, especially when you're talking about your own finances, because what's more important than that, right? I mean, we all want to hit this point where we get to retire and we've got a portfolio there that's substantial enough to sustain that. And for people to be active participants in that process, that's a good thing. And so it's thrilling to see that.
We certainly like it, and it certainly keeps guys like us in business. So we're happy to see that trend develop. But Randy, I'm glad you can make it on the show again. You and I always love chatting with you. We can go on for hours. But I'm glad you can make it on. We'll definitely have to bring you on again down the road.
Thanks a lot, Mark. Again, it was a pleasure to be with you.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program. as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.